Tom Hartman for October 28th, 2025. I'm your host, Tom Hartman, and today let's talk about the macro news moving markets. So, first off, we have here that Trump signed a rare earth deal with the PM Sanai Takaishi of Japan. I think I nailed that pronunciation. So, the idea here is that this is a story that came from Eric Doherty on X, who says that President Trump and Japanese PM Takashi have just signed an official agreement securing rare earths and critical minerals, reducing reliance on China. The Trump X Takashi alliance is off to an incredible start. Yeah, this PM being heralded in has always been interesting, and this is the first time I've seen her now interact with the U.S. in this way. And so the idea that even before the meeting on October 30th between Donald Trump and President Xi Jinping from China, that he's already trying to lessen the leverage that they might have, the Chinese might have of the U.S. because of rare earths. So it's pretty interesting. I wonder if that's why markets rallied a little bit yesterday or more yesterday, because the need for the deal plus the likelihood that it'll happen, both are trending in the right direction. Next up, this is a small snippet from a interview between Michael Howe and Jack Farley, talking about China pumping gold. Let's just take a quick look at what Michael Howe has to say here, because he is an expert when it comes to the global financial system as it relates to long-term trends and specifically about liquidity. And with gold rising sharply, it's nice to know why gold was going up so much, and he gives us a little bit more insight if we didn't know before.
The People's Bank of China is having a huge impact on the price of gold right now. China has the world's biggest physical gold market at Shanghai. It may be that London is bigger in terms of its derivative exposure, etc. But China basically has controls the physical metal. What China is doing is trying to devise or grow its financial system, not as a gold standard, but as a gold content system. So gold is very important for increasing confidence in the Chinese system. And it may well be that the US is simultaneously going on a different road, and the US may be using digital assets to collateralize the US dollar system. But China, I think, is using a partial collateralization of its monetary system through gold. Now, gold plays a key role here because we know that China has a huge debt problem and it needs to get out of that debt problem. My particular interpretation of what's been going on is that I think the introduction of stable coins has been a huge warning to China, which they've taken very seriously, the yuan gold price. Our view is that they're targeting this probably deliberately. We thought that they were going to get up to at least 24,000 yuan about a year ago. That was our target, to say that they had to do this really just to scratch the surface of debt. They exceeded that, and the gold price is continuing to move higher.
Thank you. Just close this door.
All right, you can go find the full video of that on Jack Farley's X channel. I find it very interesting because United States is talking about using just a mark-to-market gold that they have in reserves. This is the story we talked about yesterday and last week. I've been talking about it for days now. Cynthia Loomis, the senator from Wyoming, who is proposing this microcellular plan for the Bitcoin strategic reserve, where gold is marked to market. So it goes from the 1974 prices of gold per ounce to the current price of gold. And then that allows there to be more funds available because the gold will be worth more in order to collateralize that and use that money in order to buy Bitcoin. Won't cost the taxpayer a dime, sure. And so what China's doing over there in order to save their economy can cause Bitcoin to rise because the gold price will be then used to buy more Bitcoin. And I wonder if over there there's a plan to use the rising price of Bitcoin in order to save their currency, sort of like a symbiotic relationship or a vicious cycle, depending on how you see it. I better look into that. All right. Moving on to the next story here. Okay, just I had to cut down stories today about Bitcoin because the I'm coming off as very Bitcoin heavy in these daily breads, and it might seem like, oh, all my feed is about that, and that's what I look for, and all about the crypto content. That is certainly not the case. I care about liquidity. It is the Trump administration and all the propaganda in the media nowadays that is so hardcore about Bitcoin. It's unbelievable. They're shoving it down your throats. They're saying you have to own it. It makes no sense not to own it. You're going to be poor if you don't own it. This is like not degens and YOLO traders saying this. This is the government and major institutions and financial analysts just all of a sudden came out of the woodwork saying Bitcoin is super important. So this is BlackRock CEO Larry Fink who's saying this. And just keep in mind here as you're listening to this, Larry Fink is not here. This is my proposal here. Larry Fink is not here because he cares about you. He cares about his business. And if there anyone in the financial system or anything like that tells you to buy something, it's because they benefit if you buy it, right? It's the he wouldn't be saying this if he would be hurt or if he's not taking part of this profit. So he is talking his book here, but listen to what he has to say and how he's saying it.
Or if you believe that countries are going to continue to debase their currency, if you believe that there's going to be global rise of insecurity, owning crypto assets or gold are assets of fear. You own these assets because you're frightened of the debasement of your assets. You're worried about your financial security. You're worried about your physical security, and between crypto assets and gold, they believe there's a strong belief that is a good hedge against optimism.
Okay. Jamie, you were not.
I just listen to what's being said there. He's saying that if you believe that the debasement of the currency is going to continue, so presumably he's implying that this is a bad thing, something that needs to be protected against, that it can cause instability in the world, instability to the point where you're worried about your own physical safety. And this is something that's very similar to what the senators were saying before, Senator Cynthia Loomis. Why isn't the this meeting about the government stopping to debase the currency? If it's so bad and they see that it's bad, why isn't this big campaign, this big lobbying effort to have them stop that? I don't get it. They just all throw up their hands and go, hey, the governments are just going to debase the currency. You're one of the richest people around. You can be lobbying the government in order to do so. You have the ear of the president. Why can't these guys come together in order to get the government under wraps, stop debasing the currency? Well, we know why. Because the financial system is dependent on that, and the people around it make the most amount of money when this happens. This is the whole Wall Street, High Street is evil sort of thing. We know that it's not an evil thing. We know that it's an opportunistic thing, but it has to do with just the nature of a world reserve currency and the nature of game theory and geopolitics, that this naturally will occur if these incentive structures are structured the way that they are. But let's set aside the idea of good and evil here and just hear that it's Larry Fink coming here, spending his time. He doesn't need to come here for the speaking gig. He's coming here to spread the word from a name of authority that Bitcoin is absolutely necessary. And he's doing the job. He's doing the job. All right. And finally, here, I wanted to get this interview in from by Darius Dale, who was on Bloomberg a few hours ago. I find Darius Dale to be one of those follows online that is just absolutely indispensable. In fact, if you go through his past stuff, if you're new to markets, you're new to financial markets, you're new to global forecasts, you're new to portfolio allocation, you want to get a handle on it, at least to know what you don't know. Darius Dale is top of the line there. Sure, there are other people who are good as well, but I would really point to him as being one of the star players here because he has a way of he meets you halfway. He doesn't dumb down the information so you feel like you don't get it, you don't understand the terms, you don't know what to look up or anything like that. But he's not so obtuse that you can't understand anything at all, that it's boring, that it's dry. I find that he has this very nice middle ground if you have a head for wonkish financial information, the plumbing and forecasting of the global liquidity system. So this is an interview that he did, and they ask him several things that I think are quite interesting. So it's a few minutes long. Let's watch it.
All right, well, the Fed is scheduled to start its due-date meeting tomorrow, a big decision on Wednesday, with the market pretty much pricing in fully a second straight cut in monetary policy. Of course, there are some broader questions about when the next cuts will come, if at all, and more importantly, who's going to be leading the Fed by the time we get to next year. A lot out there right now about the potential successors to Jay Powell, with Treasury Secretary Scott Bessent confirming the candidate pool now narrowed down to 5 finalists, and that includes Christopher Waller, Mickey Bowman, as well as a couple other folks there, including Kevin Hassett and Rick Reeder. Darius Dale joins us right now. He's the founder and CEO of macro research firm 42 Macro. And Darius, before we get to maybe who the next Fed chair is going to be, I am curious just about this sort of rate cutting cycle that we're on. And I don't know if we call it a cycle. It's only been, one cut. I mean, I guess we get the second one on Wednesday here. But I mean, you kind of point out the Fed, to a certain extent, structurally is kind of behind the curve.
Yeah, definitely. And thanks again for having me, Romaine. Appreciate you. Yes, in our view, the Fed is very much behind the curve with respect to its policy rate policy as well as its balance sheet policy. And that's having problems in the repo market, as we saw with some of these stress indicators that were triggered in the last couple of weeks. So it's our view, according to our models, that the Federal Reserve needs to accelerate the pace of returning the policy rate to a more neutral setting, as well as turning off this quantitative tightening program.
Well, I am curious with regards to quantitative tightening, that balance sheet, if you will, just sort of right-sizing that also help with regards to this idea of having looser monetary policy, meaning they can do this by not just cutting rates?
Yeah, well, this is it's a philosophical question, Romaine, and I think this is the big question of the time, because on one hand, the Fed is implementing monetary policy from a cyclical standpoint. The big challenge for investors to figure out with regards to 26 and beyond is, will the Fed Reserve be operating monetary policy from a structural framework? In our view, we think that the risk of them transitioning to a structural framework is actually quite high, because if you think about their too tight monetary policy and the impact that it's had on the economy over the last few years, essentially the Fed's reluctance to support this fiscal dominance regime has contributed to all sorts of adverse negative consequences from a K-shaped economy perspective in the economy. And so it's our view that one of those 5 people that you put up on the screen is going to have to lead the institution to structural regime change.
Yeah, it's going to be fascinating, of course, to see how that horse race actually shapes out. You take a look at reporting. It seems like Scott Bessent wants to get Donald Trump a list by Thanksgiving, and maybe we'll get a decision soon after that. But let's talk about, the leadership of the next Fed and what they'll be dealing with. Because you think about where we're headed when it comes to inflation, you haven't seen a lot of what we're talking about when it comes through with tariffs really show up in a meaningful way when it comes to the inflation data. Then you think about the labor market. You are starting to see some wobbles there. And certainly you think about some of the layoff announcements that we're getting from companies. Amazon just today, Reuters reporting. It seems like, again, the two sides of their mandate here could be in conflict. And I wonder how you're thinking through that, especially when it comes to how you put together a portfolio.
Oh, that's a fantastic question, Katie. And in our view, that we've been operating in this U-shaped economy framework, which gives the Fed a very robust window in which to ease monetary policy. They're getting a green light from the labor market and a green light from a structural regime change perspective to actually, bring this institution to the 21st century, if you will. And so it's our view, as it relates to constructing portfolios, you have to be maximum risk on at this juncture, because in our view, we think the Federal Reserve is going to go from, I would say, not understanding the impact that their balance sheet and their policy is having on the economy in terms of creating these K-shaped outcomes, to agreeing to understanding that and actually making changes. And in our view, that's incredibly bullish.
Maximum risk on, Darius. Explain to us a little bit more what that looks like when you get down to the sector level.
Yeah, that's a great question. So on the sector side of things, whenever you're max risk on, you want to be in high beta cyclicals from a factor risk perspective and a sector risk perspective. So obviously that's a continuation of what's been working. If you think about the technology sector, communication sector, the AI trade should work. The one thing I will say is, if you're an institutional investor, earmuffs if you're a retail investor, but if you're an institutional investor and you have to pick factors, there's likely to be a significant factor rotation at some point in the next, let's call it 3 to 6 months, as we transition from a weak economy that is, given the Fed a window in which to ease monetary policy, to transition to an economy to a much more robust outlook. I'll throw one stat at you before I wrap up is if you look at the median or the mean of the 2026 and 2027 real GDP growth estimates among Bloomberg consensus, your guys, the Wall Street consensus, it's 1.9%. In our opinion, that number is about 100 basis points too low. And so we think there's a significant positive revision cycle ahead of us still from this starting point.
All right, Darius.
All right, fantastic. I love what he's saying there. So just a couple of points that I just love here. The K-shaped economy that we've heard a lot about is the idea that those in Wall Street and High Street are benefiting, those who have access to assets that appreciate in value as the stock market keeps going up and Bitcoin keeps going up and that sort of thing. They benefit, they're not suffering. Whereas those who don't have access to that, they become poor and poor and poor still relatively because they don't have any assets that go up in value. He makes the point here that the Fed has been pursuing their monetary policy by being cyclical through the because of how robust jobs were. They weren't, the unemployment rate was, they weren't cutting because of that, because of waiting to see what would happen with tariffs, because of waiting to see what's going on with the business cycle, the inventory cycle, credit cycle. They were behind the curve. But here, if they, as he's saying here, will be switching to a structural framework that has to do with the liquidity within the economy as well as the financial markets, which is suffering right now. He brought up the repo. He brought up the idea that there's funding stresses that exist. And so this provides a window of opportunity, like you just mentioned, for the Fed to start easing. That means stop running off their balance sheet and help the fiscal side, the government side, monetize debt and fund what they need to fund. And he's saying that if that occurs and now liquidity comes in a more substantial way because of the Fed leaning into the structural dynamic as opposed to the cyclical dynamic, well then the little blip up we're seeing now in unemployment and some of the weaknesses here will be shored up. And what would that mean for assets? That means that they could skyrocket from here. I mean, skyrocket. They could just keep on rising, because there would be enough health within the economy, enough forced buyers, enough market participants in order to cause the market to go up and to the right. Because both fiscal and monetary policy would be working in conjunction with an economy that's desperate in need for it. And what we're seeing at now, with even stock market at all-time highs, is with the economy suffering, massive job layoffs, tariff uncertainty, political stress, cultural issues, and so on and so forth. And so if that gets resolved, what do we see then? So he says maximum risk on, which is not something that Darius says lightly. And Ken Carson has been saying the same thing. He changed his tune a couple of months ago, and there's a number of reasons why we should think that high beta assets such as tech, crypto, AI can. We're not done yet. It could still keep going up. And then he mentions there the last thing, the sector rotation. When he was saying earmuffs, he was saying that, well, if this rotation happens, if the fiscal and monetary policies get in sync because of the change in the Fed and all that sort of thing, we get the 1% interest rates, blah blah blah. Well, then there'll be an exodus from the assets that are lower performing or underperforming and rotate or value stocks into these growth stocks, into these high beta stocks, and that could be another source of more upside movement. So it's an exciting time to be alive. This is sort of like, feels like, from what I hear, .com 1998. So still a little ways to go before the big hangover. For right now, it's animal spirits all the way. All right. That's it for today's Daily Bread. I've been Tom Hartman. I'll be back tomorrow for another market update.